your overall financial life in order to maximize income and growth, minimize tax, and optimize your protection. And I was introduced to Matt by Brett Tanner in our KW Wealth Group, who I know a lot of you know that I think that Brett is one of the smartest guys in real estate. And I know he works a lot with Matt. So I have started working with Matt, and a lot of the things that he has brought to me and taught me really, I think would be extremely valuable to all of you. So I asked him if he would take his time and come on. So welcome, Matt.
Thank you. Thank you for having me. Thank you, everybody. Appreciate your everybody fitting me into your very full calendar. I'm in Atlanta, so it's 2 o'clock here. So is everybody there in Washington?
No, in New York.
Nope.
New York.
New York.
New York and Arizona. That's right. I don't know where Washington came from. All right. So what I'll do is first just give you a little bit about me and just real briefly so you have some context. But I've been at this for 30 years. I've been at the same firm for 30 years. Married to my wife it'll be 29 years in April. We've got 4 children. My oldest she's pregnant, so we've got a grandson on the way. So we're very happy about that. And so we're very close to being empty nesters. And so we love traveling without the kids. And of course, we'll bring them along every once in a while too. And I'm very familiar with Keller Williams. Just a little bit about how I got started with Keller Williams is I actually met Gene and Sean and Gene Rawls, if anybody recognizes that name, about 20 years ago, maybe a little bit over 20 years ago now, when they first brought Keller Williams to Atlanta. And then they introduced me to another number of people at Keller Williams, started working with them. They introduced me to Bob Kalinsky, the owner of the region, and it just kind of grew from there. Actually, Brett was coaching with Mike Fleming. I don't know if y'all know of Mike Fleming, but we're coaching with him, and Mike was a client, and Brett had a question, and he was like, I don't know the answer, but you need to talk to Matt. So that's how Brett and I got connected about 10 or 11 years ago. And I've been trying to help him ever since. And he is a very unique individual. So I've never seen anybody who will take an idea and learn everything he possibly can about it and then implement it the best way he knows how. So if y'all are in his group, I'm sure you've seen some of that, but it's phenomenal, well worth the time. So I think I'll start out the first way I started out, the first conversation that I had with Rosemarie and even with Brett, because this really hasn't changed. And that is kind of review with you guys what my mission is and what my goal is. So my mission in working with my clients is really to put them in a position of financial security and confidence that they didn't have prior to meeting me and would not have had if we had not met. And of course, that's there's a lot there. That's, it's wide and deep for a reason. There's a lot that we cover. And I also recognize that a lot of the people that I talk to, a lot of you guys probably already have a number of financial people already in your lives, but I still want to accomplish my mission. I still want to go above and beyond kind of what what you've been taught, what's been explained to you. And I want to go above and beyond and bring you security and confidence in addition to all of that. So, and then my goal is very specific. Now, it's the same for every client. How it's carried out is very, very different. My goal is that my clients become financially independent. And so I think it's probably worthwhile to define that. So, because I think financial independence can mean different things to different people. So I think it's worthwhile to define that. So financial independence to me is that point in time where somebody has enough assets and those assets are generating enough income that they get to live the life that they want to live, do what they want with their time, and they never have a concern they're going to run out of money. So everything that I do and we'll get into a little bit more of the areas that I work, but everything that I do is geared towards those two things. So bringing you security and confidence around any sort of financial decision that you make or might make, and then leading you towards financial independence. So that's kind of it in a nutshell. And I'm happy. I'm not awesome with technology. I'm okay, but where I'm not looking at the chat. So Rosemarie, maybe if somebody throws a question in the chat, I'm happy to answer it. And I can't see everybody, so I won't see if your hand goes up or anything. Or if you throw something at the screen because you don't like something I said, I won't be able to see that either. So, oh, there we go. Now I can see at least most of y'all. So I'll start with the number one thing, the most important thing when it comes to becoming financially independent. And at the end of the day, it just comes down to one thing, and that is the ability to delay immediate gratification. Now, that ultimately what that looks like is someone saving or investing roughly 15 to maybe upwards of 25% of their gross family income. Now, being in the real estate business, probably everybody on this call is either a real estate entrepreneur or desires to be a real estate entrepreneur in some form or fashion. And if you don't, you should, because it's a great way to build wealth. But so finding out what that gross family income is, I get that can be a little bit complicated. It's not necessarily what you pay taxes on, and it's certainly not necessarily the top line that your top line commission number. But in working with our clients, we can kind of get to what that number should be. But again, we were shooting for a 15 to 25% annual savings. Now, keep in mind, when I say savings, I don't mean putting it into a savings account. I use that synonymously with investing. And when I say investing, I mean investing in anything for long-term wealth building. So it could be real estate, it could be notes, it could be rent, it could be rentals, it could be multifamilies, it could be stocks, it could be retirement accounts, it could be private placements, limited partnerships. Any and all of those things count. I'll get to a little bit. I'll break that down here as we get through this. But so when we talk about saving, we're talking about saving or investing in those places. And what we know for a fact is that willpower alone will not do it. Meaning, or said another way, we can desire to, all right, I'm going to say, you wake up in the morning, you're like, all right, this year, this week, this month, I'm going to invest 20% of my gross family income, right? Or 10% of my GCI, or however you want to calculate it. And you've got all the willpower in the world, and maybe it lasts for a couple of days, but we all know that human nature actually will eat willpower for breakfast. Like, it'll last for a while, but eventually human nature just takes over. So what I try to encourage my clients to do, and maybe some of you have seen this, is actually build a system how to run your cash flows so that you're not depending on willpower to make sure you're doing the right thing. You're actually depending on a system, and it's a system you and your spouse or significant other can help work with, number one. And number two, to the extent you have children, I would want them to overhear the conversations that you have, such as, and I can't remember, Rosemarie, if you've heard me use this example, but I should back up. It's a two-part goal. I didn't go through the second part because of the big disparity of maybe ages and maybe families and maybe not families, or young babies or no babies or out of the house. But the second part of the goal is if you have children, my goal is that they become financially responsible and generous adults. And they do that by you doing the right thing and talking about doing the right thing with your spouse, with your significant other, in front of them. So here's a perfect example. The conversation they shouldn't necessarily overhear is, hey, I want a new car. Do we get the BMW or the Mercedes? Like, that's not an ideal conversation for a child to have. However, what they should hear is, look, we can buy a new car, but we're going to wait until we hit these certain goals, savings goals, net worth goals, income goals. And then when we hit those, then we will determine what car we want to purchase. Much better conversation. So back to the cash flow piece. So I think what I want to do, if I can share my screen, and I know some of y'all are driving, but I'm going to share my screen because I want to walk through a cash flow system. And again, I'm quite certain if you've been to some of the KW Well things, whether it's Jason Abrams or whether it's Brett or somebody else teaching this, you may have seen this cash flow system. But sometimes there's something to be said, A, in a smaller group versus a bigger setting, and B, you're kind of hearing it from the source, since Brett and Jason and company have kind of learned this from me. Not that I'm the originator of it. I can't take 100% credit for it. I've turned it into my own, right? We all do that. We take good ideas and we turn it into our own. But I want to walk through on here kind of how most people run their cash flows and why that will never lead to financial independence. And then I want to walk through a much better way to run your cash flows. So if you're driving and you're not headed to an appointment by such and such time, might be worthwhile to watch this. So how most people do it is, first of all, we've got a family checking account. Okay. And that might be his account or her account, or however you guys however you pay your bills. But generally, all money from all sources tends to flow into this family checking account. You do a flip and you make some money, it goes into the family checking account. You make a little sale, it goes into the family checking account. You make a big sale, it goes into the family checking account. Now, I recognize it may go into a business account first, but then it goes into this family checking account. And here's where the problem occurs, because everyone has in this checking account limits. And particularly if you're married or you've got a significant other, you have different limits. So number one, the limits exist. You don't know you have them. And if you have a significant other, they have different limits. And here's what I mean by that. And you guys know that this is true. You know that you've got a lower limit on that bucket of money, because if your account value goes below that limit, we all do the same thing. We stress out, we stop spending, and to the extent we can, we work a little bit harder to make more money come in. Okay. We also know there's an upper limit. And we all know what happens here. If we're sitting on excess money on top of whatever our limit might be, what's the first thing every red-blooded American does with the excess? Most of y'all look like you're on mute, but I'll answer the question. Nobody's ever gotten this wrong, so I'm sure y'all came up with it, but you spend the money, okay? And it's only until someone reaches what I refer to as a guilt level of spending. So you've bought this, you've bought that, you've bought this, you've bought that, you've bought all these things are going well. And finally, you look at your account, you look at all the stuff that you bought, and Amazon's been lighting up your driveway, and you look and you're like, wow, we have excess, and really I'm a responsible adult, and so I'm going to pat myself on the back and I'm going to say, you know what, I'm going to throw some of that money into a savings account. Now, guess what we have in our savings account? You've got upper limits and lower limits, and the exact same thing happens. So if your account balance goes too low, you stress out, you stop spending, and you work a little harder to make more money come in. If there's an excess of money in there, we do the same thing. Now, here's the difference. The first group of spends tends to be on smaller items, right? Eating out more frequently, clothing, those types of things. But the spend out of the second bucket tends to be a little bit bigger, right? If your savings account gets that big and you're feeling good about yourself, you add a pool, you add a wing to the house, you improve your kitchen, you buy a second home, you buy a third home. That's what tends to happen here. And again, you reach a guilt. It's not until you reach a guilt level of spending, if you actually reach one, and I think most people do. But once you reach that guilt level of spending, you again convince yourself you're a responsible adult. You pat yourself on the back and you throw the money into some sort of an investment account. Again, it could be real. I'm not stating what kind of investment. I'm just saying you finally decide to invest the money. And so this as a strategy can never equate to financial independence. You'll never become financially independent chasing that. And we all know that, right? So, and I have yet to speak to anyone who was taught a better system than what we're looking at. Now, that's not to say I haven't met people, Rosemarie being one of them, who had a phenomenal system in place when I met them. But it's very, very, very rare. So let's walk through a system of cash flows that allows you guys to think, to bracket your consumption and then think about wealth building first. So let's assume that we have, I'm just going to identify a few sources of revenue. So you've got maybe a salary, maybe you've got distributions or excess commissions, maybe you flip a house here and there, maybe there's another business. So all those businesses and ways to generate revenue are represented by these 3 buckets up top. It might be 10 buckets, it might be 1 bucket. That's not relevant, at least for this part of the conversation. The point is, we still want all of the excess and all of the money, whether it's salary, distribution, big profit, little profit, you sell a house, whatever it is, we want it all to go into one account. Brett loves the term the war chest. So guess what? I keep using the word war chest. Okay, we throw it into this war chest. This is not a personal checking account. This is a place for you guys to build and accumulate money for opportunities that come. I'll get to that. But first, we have to have a reservoir that can capture all of the excess. Okay. Now, what we want to do in that war chest is we want to establish a buffer that we don't want to go below. Okay. That could be $50,000. It could be $1 million. It depends on the person. Okay. I won't get into that now. We do on the one-on-one basis, but we just determine whatever that buffer is. And then the other thing we want to do is we have these bills to pay, right? And they're not going away anytime soon. So what we're going to do is we still have our family checking account, but it's one step below all the business accounts and things that you've got up here. So all we've really done, as you can see, is we've just inserted one account to catch the money, and then we're still going to flow it into that family checking account. And let's just say it takes, I'm going to pick a number. Let's say it takes $10,000 a month to live the life you want to live. Now, note, I didn't say if it takes $10,000 to live, go find a way to cut out 30% of your expenses. I want you guys, and I want every single one of my clients to live a great lifestyle. And I don't want you to spend less. I actually want you to spend more, right? Within reason, right? And as your wealth and income grows. So this is not a feel bad about yourself, kick yourself. It's 10 grand a month. I wish it were 8. Like if it's 10, call it 10. We'll get to that later. Okay. The other cool thing about what you guys do, similar to what I do, is you guys have a direct impact on what your income is, right? So you have total control over what your income is. Now, I'm not saying there's not outside forces, particularly what's going on right now and interest rates, but you're still 100% responsible. So what if that's $10,000? Whoops, if that's $10,000 a month, we're going to set $10,000 a month ACH. So once a month, electronically, automatically. By the way, this is your new paycheck, because your other paycheck, your other W-2, if you've got one set up, is flowing into this war chest. Okay, because your paycheck or your salary may have nothing to do or no bearing on what you spend on a monthly basis. So let's just say it's 10 grand a month. We're going to start with a buffer in that family checking account of about 10 grand a month. So ideally, what happens in that account at the beginning of the month, it's 20 grand. At the end of the month, it's 10. Beginning of the month, it's up to 20. End of the month, it's down to 10. And we've got that buffer in there because you guys know if your spend is roughly 10 grand a month, it's never exactly 10 grand a month. Sometimes it's 12, sometimes it's 8. Okay, so what we've done is we've got kind of your monthly bills kind of handled, right? And if you find your burn is $12,000, my first step wouldn't necessarily be to go cut out $2,000 of expenses. I'm not saying you shouldn't. I'm saying that's not my first move. My first move is to bump up the monthly from 10 to 12, right? So, but in addition to the monthly, we all get hit with what I call life events, right? Sometimes we foresee these coming and sometimes we don't foresee these coming. My, my example is getting a little bit old, but it's still a very pertinent example. So this month, 6 years ago, 2017, I didn't count on two things. I didn't count on the sewage backup in the basement where my oldest daughter had a room. I didn't count on that. And I didn't count on laying out 30 grand just to fix it before the insurance could take care of it. Nor did I count on the Georgia Bulldogs going to the national championship that year, me buying 6 tickets, at least half of which were at the top price. Like, I'm that fool. 3 I got for face value, but 3 I literally paid if you watch the prices, I literally paid at the peak. But I won't bore you with more of my woes. I'm just saying, in that month, those 2 things happened, and it was collectively about $45,000 of expenses that I didn't foresee coming. I had to have that handled. That's a life event, right? Your next car, the roof that you know is coming, the bathroom you know needs to be remodeled. We need an account for that. And we need to have some money in there for stuff we don't foresee coming, as well as for the next car we're going to purchase, or the remodel, or the vacation. So we call this a life events account. I think Brett and Jason just referred to it as a savings account. I literally want my clients to name it their life events account on their app. And then we get to, we see that, and we see what, we all call these things the same thing. And let's say that's, let's pick a number. Let's say it's $30,000 a year. Okay. But now, and hopefully you guys see this, what we've just done is we have just bracketed your consumption, right? So now, if you have an awesome year, you've still bracketed your consumption. You don't feel the need to go out and spend the money, because when you look at your checking account, it seems to hit roughly $10,000 every single month, and nobody feels wealthy with just $10,000 in the bank. But that's what you look at, and that's what you see. So it gets you into that. Hopefully it gets you into that where you bracket that consumption. And again, I said I want you to bump that up, but I want you to bump it up within reason relative to your income and your net worth and those things going up. And we help clients kind of guide them through. If we think they're spending too much, we will let them know, and then we'll fix that. We'll fix that. So the other thing that I want to make sure my clients do is I want to make sure that they set aside money for taxes. So we should have a tax account. So in addition to your W-2, which automatically sends money to the IRS, when you make distributions or when you make profits, you make a sale, you flip a house, whatever the situation is, we need to carve some money out to go into a tax account. Because one thing I know consistently blows up clients' cash flow plans is a tax surprise by their CPA. I'm quite certain nobody on this call has not gotten a tax surprise from their CPA. So what we help our clients do is identify, if they don't have a great tax strategist, we help clients identify what their tax bill is likely to be, at least very close. And then we want to make sure they're setting that money aside. Okay. Some of y'all, I've got some clients that we're gifting money, and giving to charity is very important. That can exist one of 2 ways in here. It can exist inside this, and it's a separate pot, or it can fit inside the life events account or the family checking account. So again, now what we've done is we've bracketed taxes. Like, if you've set enough aside for taxes, and again, we work with our clients to make sure they know they're setting enough aside, and we've bracketed your consumption. Now we all know what's left. So long as more money is coming in the door than it takes to pay your taxes and live your life, what should happen with this war chest over time is that account balance should build and grow, right? And so now we have a place for that to accumulate. And as it accumulates, we shouldn't be tempted to spend the money because it's not sitting in that checking account. We should have our eyes on wealth building. And so what are some of the assets that my clients invest in? What are some of the assets you guys may want to invest in for the building of wealth? Well, there could be notes, and this is not an exhaustive list. There could be, You could do a flip, right? You could do a long-term rental. You could do, investments, more typical investments. I tried my hand at real estate investing. I'm real good at helping clients identify the math and the money and the financial aspect of making real estate investments. You just don't want me investing in you don't want to take my advice to invest in real estate. I tried that, and up until like 2007, I was the best real estate investor on the planet. But then 2008 hit, and I've stopped trying my hand at the real estate investment game. So what I like is limited partnerships, private placements, private equity type of stuff. You guys might see some of those. I know a number of folks that I work with at KW have opportunities to invest. A lot of times they're multifamily limited partnerships. So that would exist there. Okay. So this is what we can do while we're building and accumulating the wealth. I just want to stop there, Rosemarie. I didn't know if you wanted to comment, if somebody had a question, because I just been running through this thing and haven't even paused.
Well, I think you threw out a lot of great information there, Matt. Does anybody have any questions on this concept? It's a great concept, and I think it's a really good way to easily create the money that you need for investing, and to do, what Matt is saying is sort of bracket it and segregate it out from the money that you need to live with. And it's a quicker way to do it, for sure.
Yeah, and I'm trying to be very mindful of the time. So I'm a hair ahead of schedule, which probably tells me I've been talking too fast. So if you've got a question, you're not going to throw us off from a time standpoint. There's a decent chance if you've got a question or a thought or a consideration, somebody else has the same thing. So
yeah, so Christine is asking the question here, is investing in companies another asset too? Yes. Yes, investing in companies, LLCs, businesses,
yes.
it's certainly an asset.
Yes. Yeah. And depending on what type of business, that could either be, considered down here or maybe that one there, but that's where that is. So, and by the way, I'm also just going to throw in a big O for other, like other things that you guys come across. And by the way, in my world, advising, 100% of my clients are entrepreneurs. And so in my world, in advising my clients, there's only two types of assets. And I think this is a good time to bring this up. One is entrepreneurial assets. So those would be, it would be those assets that you have, direct or at least partial control over. It could also be things such as investing in a company with a friend who started the business, or investing in a syndicated multifamily limited partnership. They tend to be a little less liquid. The rates of return tend to be a good bit higher than your average typical, stock market type investment or bonds or whatever that might be. So entrepreneurial assets, and then what I'll call financial assets. Those are all the things that most people think about when they think about assets: stocks, bonds, IRAs, 401ks, cash, treasuries, money market accounts, those types of things. I used to refer to them as paper assets because they were all paper. Now a lot of that's online, so I just call them financial assets. So, and this can encompass either one of those. Okay. All right. So now
Wait, Matt, we just have a couple of questions here about the war chest account. One question Cindy is asking, is that a regular separate checking account or something interest bearing?
Great question. If you're Brett Tanner, it's going to be the highest interest earning account you can find, because that's who he is. If you're Matt Lipscomb, I'm all about simplicity. So it's going to be a crappy checking account at Wells Fargo, where I'm ashamed to say I bank. So it depends on what's important. Like, to me, ease of use is important. for the longest time, I was raising 4 kids, and I guess Brett's, he's got 3, so he's not that far behind me, and he still finds time to do it. I just didn't. It's just not something I wanted to do. But yes, I do have some clients, and they'll go to, American Express, or they'll go to Capital One, or they'll go to online banks. But the key is it's not the interest that you're earning, because ideally there shouldn't be a ton of money in this account. So it's less about what you're earning on it, and it's more about the ease of use. Like, how quickly can you see it? How quickly can you move it out? Can you close with cash on that flip, this week, and get the deal versus have to wait until you compile your money, for example.
And I just want to add to that, that I do have that type of money in American Express and Capital One. Those are pretty ease of use. And right now they're both paying, I think, around 4.3% interest, which is pretty nice on that money sitting there. But that's not the concept for this. Christine is also asking about, is that is the war chest the same as a liquid cash account?
So yeah, so generally for most clients, I want it to be a checking account. It could be an interest-bearing account. It could be a money market account, but there's probably going to be so much money coming in from different places and potentially going out to different places, and there's limitations on what type of accounts it can be. So most clients just default to a checking account. You certainly don't have to. And this might be a follow-up question, but I'm going to go ahead and state it. The war chest, almost 100% of the time, should be a brand new account that's never existed before. It should not be a repurposed account, because with a repurposed account, we all kind of go back to where the bed is warm and we get into our old habits. And if this account used to be used a certain way, it's easy to get back in that habit. But if it's brand new and you're like, nope, I'm turning over a new leaf, like, this is a new system, it's a brand new account. But it is also a personal account, not a business account. That's not, I do have clients and they use business accounts for that. So I'm not saying the system, well, let me hit the pause button on this. The idea behind this for everybody on here, because you all probably run your cash flows differently. So the idea isn't to do exactly what's going on the screen. The idea is to take the psychology of what's going on the screen and overlay that psychology, discipline, and intentionality over how you run your cash flows. Right. So, but normally the war chest should be a brand new account, and it should be a personal account. The tax account should be a personal account. Obviously, your family checking account should stay what it is. The life events account was probably your old savings account, and that's okay to repurpose it that way. I would just call it something different. So what we want to do is we just want to draw a line between the business accounts up top and then all the personal down below. And what we're doing is we're spilling over to an asset protection area. So somehow, even though I've got notes here, I skipped over the 3 areas where I work. So I'm going to keep my finger on the pause button and just run through that real quick. So number 1, in helping clients with their goal and with the mission, is helping them accumulate and conserve their wealth. And it begins and ends with this cash flow system. So that's sort of number 1. Second area where I help clients is from a tax standpoint. I'm not a CPA. The role I try to play there is as a tax strategist, but not being a CPA, I send everybody back to their CPA to verify what I'm seeing. But I'm fairly good in that area. I've got many clients that have saved hundreds of thousands of dollars and even millions of dollars based on my ideas, even ideas where the CPA has said, no, that's bunk, it won't work. But we did a little more digging and we found that it did. So that's a second area. And then the third area where I help clients is I kind of refer to it as all things protection. So protecting your assets, protecting your income from anything that can erode it, confiscate it, deplete it, take it away. That's including lifestyle inflation, right? Which is just a fancy way of saying the more you make, the more you spend. Tax increases, dying too soon, living too long, getting sued, which is a real thing. And so now I'll unpause and go back to my point. I want this yellow line. I want all your business assets kind of separated from your personal, because if you're going to get sued, you're probably going to get sued because of your business, because of a rental, because you've got somebody in your car, because, those reasons. So it's more likely to come on the business side. And so we want everything down here. It's easier to protect assets on the personal side than it is on the business side. What we do want to do, though, in the business accounts is minimize the exposure there. Or I'll say that in more simple terms, do not accumulate a bunch of money in your business accounts. If you're sitting on a substantial amount of excess money in your business account, establish the wealth coordination account, flow that excess down into that. Because if you're sued, even if it's a ridiculous lawsuit, which I know something about because of my knuckleheaded son rear-ended somebody, and we both got sued for it. And mind you, he wasn't hurt, my son nor the other guy, but he sued nonetheless. But we want to make sure that we've got the protections in place. So if it happens on the business and you've got an extra $100,000 in your business account, a judge somewhere in the county where you live can say, you know what, we're going to freeze that money. You can still run your business, but we'll leave that there, which means if opportunities come, you can't use the money. If you wanted to now go and protect it, you cannot. So I want to make sure that we're moving everything down below that yellow line that you see on the screen. Were there any other questions, Rosemarie?
I do not see any right now.
Okay. All right, we're still doing great on time. So now let's think about, so there was something that I know Brett has talked about it. I don't know if Jason Abrams has. I know Rosemarie and I have had some conversations about it. And here's where I'm going with that. The thought is, while we are, let me get rid of some of these highlights so as not to confuse things. While we're accumulating money here, and while this money is building and growing, the question is, what do we do with it? And right now, most of my clients, I don't know if you guys are any different, but most of my clients aren't seeing a ton of opportunities out there, right? With interest rates where they are and cap rates where they are, it's very difficult to find a piece of real estate that's worth buying or that's cash flow positive or even cash flow even. So most clients tend to be sitting on cash right now. The other thing that happens with a lot of my clients is they get good enough at their business, at their job, at their career, that more money is coming in than they can readily deploy, right? So they're spending some money, they're paying their taxes, and more money is coming in. You guys might have experienced this in 2020 or 2021. Hopefully you did. And more money is coming in, and you're too busy to figure out what to do with it. So you want to identify some good places to hold that money. So what are a couple of those places? Well, one would be cash. It's what everybody thinks about. Another could be bonds, treasuries, CDs or stock, cash value and life insurance, home equity lines of credit on your primary residence. Now, most people think of most of these, but very few people think of all of these. And they're all really good storehouses of capital for different reasons. So what I wanted, and the two that people tend to not think about, is the home equity line of credit, and the other is using life insurance cash values. And so I wanted to walk through this piece for this group, so you guys had some information on that, only because I know Brett has trained on this, and I'm guessing Jason has, and I don't know if y'all have been in training with Clarissa or Gabby, but I know they will train or coach on this as well. So I want to switch the conversation specifically to a unique way to use life insurance. And let me go ahead and I'll stop sharing my screen temporarily. And where did that go? Well, I'm looking for something and I can't find it. I will come back to it. Yeah, sorry about that. Apologies. I've got it on my email. I may just slide that over here in a minute. So I want to talk about a unique way to use life insurance that most people haven't thought of. Again, if it's looked like there were some positive responses when Rosemarie mentioned Brett. So I'm sure y'all are not just familiar with him, but have probably heard him. So I want to walk through this. So here's the idea. I think the way to think about life insurance is, first and foremost, there's four. And by the way, all of this relates to kind of what I'm going to walk through, the finish kind of the cash flow piece. But this is just one of the pieces that could fit. I'm not saying it fits for everybody, but I'm saying it could fit. So there's four reasons that individuals will own life insurance. So let's walk through those, because probably one or maybe two of these, maybe even three of these you're familiar with. So one is to make sure that if somebody passes away, their family has enough income, to last for some period of time. I usually have Mitchell, my young partner, on the call. He's young. His wife stays at home. They've got a 1-year-old. And so if he passes away, his wife and little Henry need a lot of money for a lot of years. And so term insurance is the best solution for that. Okay. The second reason individuals will own life insurance is if they have an estate tax problem. I'll use an example. If someone passes away with current tax law, if somebody passes away with a $50 million net worth, the IRS comes knocking at their door 9 months after death and will extract about 10, 12, $15 million of estate taxes for their great crime of accumulating $50 million of net worth. Now, you guys know how this goes. If that's real estate, if that's $50 million of real estate, how much real estate do you have to sell in 9 months to have enough cash to pay a $12 million estate tax? I don't know exactly what the number is, but it's way more than $12 million. So you have to, because you got to sell it quickly and it's got to be cash because the IRS is going to come knocking. So that's more of a permanent need. Like somebody who accumulated $50 million probably isn't going to lose it. So that's a permanent need. So term insurance won't satisfy that need because term insurance doesn't generally exist until you die, particularly if you die when you're older. So that's the second reason. The third reason, I'm actually going to go back to my screen and I'm going to draw this because I think it's easier to draw. And you guys have probably seen this if you've ever talked to, oops. I don't know if I shared my screen or if I didn't. Let's try that again. Okay. All right. Are y'all seeing the same screen as before? Because it's not highlighting on my end.
Yes, we are seeing the same screen as before.
Okay. Yeah, it's just not showing that it's showing. So, okay. So the third reason individuals will buy life insurance is they will be convinced, generally by the person selling it, that if they pay X amount of dollars for X number of years, they will have cash value build up and grow. And then at the point they retire, they can then start taking a tax-free income stream, and this income will help them supplement their retirement. Okay. I'm assuming, I can't see everybody on the screen. I'm assuming that probably y'all have seen that in some form or fashion. But it's trying to use life insurance as a supplemental retirement vehicle. This as a strategy, I'm not identifying anything with the product yet, but as a strategy, this will increase your risk and it will decrease your rate of return that you could have gotten if you used the policy differently. And so I don't know about y'all, but I've had enough experience with high risk, low rate of return assets. I don't need any more of those on my balance sheet. So that's the third reason people will buy it. I'm not saying you should do it, and I'm actually saying you shouldn't do it, or at least you shouldn't do it this way. So if you have a policy like this and you're attempting to use it this way, or you're being coached to use it this way, don't fret. There's a better way to use it. it doesn't mean the product is necessarily bad. Okay. So now what I want to do is I want to walk through the fourth reason that individuals will own life insurance. And I'm just going to pull up apologize having to do it this way. But I had a PowerPoint and it's disappeared on me. Unless the PowerPoint icon has changed. Nope. I'm just going to share with you this. Okay. All right. So you don't need to see these numbers, so don't start squinting, or I'll blow it up here in a minute for you. But oh, is this how we do it? There we go. All right. So this is the FDIC website. This is an old view. It looks a little bit different today, but each one of y'all can go on the FDIC website and get a snapshot of your bank's balance sheet. As exciting as that sounds. And this is Wells Fargo. It's where I bank. It's well known in the East and the West. And so I just pulled out Wells Fargo. And I want to identify, so you can see these are all their assets all the way down and their liabilities. So I'm just kind of giving you a screenshot to see what those are. So I'm going to go to two particular assets on the balance sheet. One of those, so down here, line 10, you can see it kind of near the bottom, bank premises and fixed assets. That's all real estate. Okay, so on their balance sheet, they lop off 3 zeros because when you get into the billions of dollars, I guess that's what you do. But they have $10.6 billion of real estate on their balance sheet. Okay. They also have life insurance cash values. So let's see how much life insurance cash values they have. Life insurance assets, again, near the bottom middle, they have $19.5 billion of life insurance cash values. So I'm not a mathematician, but that's about twice as much money invested in life insurance cash values as they have in real estate. And these are banks. So the question that I began to ask myself when I uncovered this little fact back in the mid to late 90s was, why are they doing it and how are they doing it? Okay. And how and why they're doing it it answers the fourth reason individuals will buy life insurance. And that is to basically use it very similarly to how banks use it, but obviously in an individual manner instead of a big corporate manner. So I'm going to go back to my drawing board, assuming I get this right. Okay, so back to my drawing board. So this is kind of how the banks do it. So banks have, here's their balance sheet. Banks have all their other assets over here. You could almost kind of think of the other as their version of entrepreneurial assets, higher rate of return assets, more risky, but higher rate of return. Okay. And this smaller piece of the pie is what banks call tier 1 capital. That's going to be their safe stuff. Now, this is how banks divvy this up. I'm going to make this about us and about you guys here in a second, but I think it's important to understand. If we took the tier 1 capital and we said, well, what does that balance sheet look like? That balance sheet is going to look like a little bit like this. It's going to have some stocks, some common stocks. It's going to have some preferred stocks, lower rate of return, higher dividends, safer generally. It's going to have bonds and other safe assets. And then it's going to have a little bit of cash, and it's going to have a ton of cash value inside in the life insurance policies. Now you may ask yourself, well, who's the insured? Like, who are all these banks insuring for all these money? They're insuring the executives of the bank. I actually have clients that used to be executives of banks The banks took out life insurance on them. They're no longer at the bank, but guess what? The banks still have the life insurance on them. They will still benefit from the cash value, and they'll still benefit from the death benefit. So I'm not walking through this to bore y'all with how banks do it, but I think it's important if you kind of understand how it was for me anyway, to understand, all right, what in the world are they doing? Because my clients may want to do the same thing. And actually, it wasn't that generous of an initial thought. I will confess, my initial thought was, how in the world can Matt and Melanie Lipscomb benefit from this? Sorry, I apologize. That was my first thought. But it turns out my clients benefit from this as well. So the idea is very similar. So what does this then look like for an individual? So let's look at this. So my clients have their asset mix might be a little bit different, but let's just say this larger swath is your entrepreneurial assets. Okay. And of course, what's going to happen is over time, depending on how much money is coming in, depending on what type of opportunities are out there, the amount of entrepreneurial assets can grow tremendously, or it can shrink, right? As opportunities are less, you build up your cash, and you're building, waiting for that next opportunity. So here is where I want my clients to think about this as an asset, the exact same as the banks. These tend to be your safer assets that you have access and control to, that is part of your war chest. And so that could consist of cash, bonds, and maybe stock. Quick admission, not all my clients own stocks. Yes, it's part of how I get paid, but not all of them own stocks. Brett, he's made the story public. He doesn't mind me telling it, and he said that. We actually talked about it in front of a Keller Williams group back in May. He actually had investments with me. And this is 10 years ago. It was $300 and something thousand, $335,000. And he sends me a text over the weekend, and he says, "Hey, Matt, I think I want to do something with that money. Can I get it?" And I texted him back. I was like, "Sure." Because all my clients, again, are entrepreneurs. So I'm always ready for their money to be deployed in something better. And so he called me Monday. We talked about it. And that's what helped him start his hard money business. He took $335,000 out of the stock market, invested. And we joked about this in Austin, because I think it was like 18 months later, I called him. I was like, "Hey, Brett, what have you turned that $335,000 into?" And he was like, "Well, some's invested, and I've reinvested some, so I'm not real sure. Probably $500,000." I said, "Well, that's a shame, because had you left it invested, it would be worth $350,000. So obviously, that's the difference in entrepreneurial assets versus paper assets. So now we're thinking about this safe and accessible money. And so where might the life insurance cash values fit on this balance sheet? And I'm going to go ahead and draw some lines. I'll say your cash is there, and your bonds are the bigger piece. I'm not saying that's exact. And then the stocks are the smaller piece. So where does the cash value fit in this piece? And what I would say is it kind of fits about here. So instead of all this cash, a bunch of bonds, and I don't have any of it covering any of the stocks, they have cash value instead. It works similarly. The rate of return is similar. The guarantees are better. Beyond $250,000, it's way more safe than money in the bank. It's got guarantees that bonds don't have. It's asset protected from creditors, which these other assets are not. I used to own bonds. I own 0 bonds these days. I either have cash value, stocks, or entrepreneurial type assets. Okay. So this is where that cash value would fit. Now, in terms of rate of return, again, just so you guys can see what the rates of return might be, maybe the stock rate of return is in the 8 to 10% range. Maybe the cash rate of return is in the 2 to 4% range. We have to keep an eye on that though, because that 2 to 4 is taxable. And at various tax rates, the top tax rate, particularly in New York, it's over 50%. So if you're getting 4.5% and you're in the top tax rate, your after tax rate of return is 2.25%. And then the bonds, again, these days tends to be in the 3% to 6% rate of return. And the cash value kind of resides right about in this spot in that 2 to 6% rate of return. That's where that resides. So you can see on a rate of return basis, you don't give anything up over time. Does that make sense? All right, I'm going to pause here, see if there's any thoughts, comments, or questions. And then what I want to do is walk through how people with wealth can utilize the death benefit. Because if we go back to the reasons people will buy life insurance is, number one, we'll use Mitchell as an example. And by the way, I still own term insurance because I do, my wife would still need a whole heck of a lot of money if I were to pass away. So I still own term insurance, but and now I lost my train of thought. That's what happens when you turn 55. Let me come back to the cash value, because I think what I was referring to there is how does that fit on the balance sheet and how do you cash flow that? So let me go back.
Matt,
Yes.
this is great information. I hope everybody on here is getting a lot out of it. And I think they are, because they're also hanging with us. But we are up to our hour.
Oh,
So
I had us for 90 minutes.
no, it's only an hour.
I'm so sorry. Here I tell you I'm good on my time and I'm not. I'm horrible. I am so sorry.
That's okay. If you would like, we can have you back and finish another half an hour, at another time. Probably
No,
next.
that's my mistake, everybody. I apologize. There was only about probably 3 minutes left to tie in how the life insurance is used by people who actually have wealth.
Okay, so why don't you do that then? If you only
Okay.
have 3 minutes left.
Okay. So, so I will use an example, a real life example. Anne-Marie or Rosemary, I can't remember if I used this with you, if you've seen this, but I had a real
Yes.
client. I'll fast forward some information. This was years ago. We're doing retirement planning. He had a 401k worth $1 million. He also had a life insurance policy that I had nothing to do with. He's 65. I just met him. He had $300,000 of cash value and $1 million of death benefit. And we're doing a retirement planning. He's got $6 million. We're running with his assets and we're saying, okay, how much income can you take from each of these assets? We came to his 401k. It was $1 million. I said, Richard, these are your two options. You can take $42,000 per year for as long as you live and as long as your wife lives. When you pass away, there's $42,000 per year for her. He said, great. I said, option number two is you can take $72,000 per year. And that money comes for as long as you live and as long as your wife lives. The only problem is when you pass away, there's no money left. And guys, this is not rocket science. This is option number one is we're just peeling off the interest, preserving the principal for his wife. Option two is we're spending the money. We're taking the interest plus we're taking principal. Think about a 30-year mortgage in reverse. That's what we're doing. We're taking that money out. So when he passes away, there's nothing left. I said, Richard, which of these options do you want? He said, Matt, we got to go with the 42 grand. His wife chimed in. She's like, no, honey, 72 is more than 42. He was kind of like a little condescending. He was a banker. He was like, no, honey, but don't you understand? You get zero. She was like, no, honey, don't you understand? I'm going to get this $1 million tax-free death benefit, and I'm going to get to go do $72,000 a year all over again. So just in summary, the existence of the death benefit allowed his $1 million that's in a completely separate, has nothing to do with the life insurance, but the existence of the death benefit, because he had wealth, allowed the $1 million to spend like it was a lot more than $1 million. That's just one of a few examples, but that's probably good enough in the time crunch. And again, I apologize.
Yeah, and also I just want to say for investment purposes, the way that Matt is structuring the policies, I know at least, I just did one with him. It basically in my second year will allow me to, it will get such a big cash value that I will be able to tap that and invest that money. So even though I'm paying towards the policy, I'm going to have such a big chunk of money in the cash value. And when you borrow against the life insurance policy, which many banks allow you to do, and I believe that I think mine is through Guardian and they will do it right there. You continue to earn interest on the cash value that's in the life insurance while you're paying interest on the money that you're using. So you're only actually paying the interest spread, and the interest spread may only be 1 or 2 points. So it's very, very, very cheap money to be able to use and put into an investment.
Exactly. Yes. And I did have an illustration to walk through as an example, but that so again, everybody, I apologize for the mix up, but hopefully this was beneficial. Hopefully it was good. And
Does
if you
anybody
wanna,
have any quick questions before we're gonna go? And Matt, while they're doing that, maybe you in the chat you can type in your information. So if anybody would like to have a consultation,
sure,
they certainly could.
sure.
Any questions on any of this? I think this was some good stuff today. No one with any questions.
All right.
Did
So
you
I
guys
just,
learn something today? Hopefully.
that's the wrong number. I'm panicking and upset with myself and I can't think straight. 964. Okay. So, and I am, because this is on me, I'm happy to set up another call to walk through this in more detail. I had a couple tax ideas because I thought I would have some extra time, that we can also walk through. And so I'm happy to do that, because I think
We'll
somebody's,
get you back again, Matt.
okay, let's do that. So, I'll have Elizabeth reach out and I got 25 minutes. So if y'all can stick around and you want to ask questions, I'm happy to do that.
I have to jump onto another call, so I
Okay, sure.
have to be out.
Thanks for the, okay. All right. Thanks, everybody.
All right, thank you guys.